So what are some of the dynamics playing themselves out in the fixed income markets at the moment? Has anything materially changed since last year that needs to be considered right now? So Albert, let's get straight into this topic, because May, in fact, if you're looking at the month of May, we saw pronounced sell-off in global bonds. In fact, the worst monthly loss that we've seen in 9 years. Are you concerned about what's taking place in the bond market right now? I mean, what do you see as the key drivers behind this?
Well, Sam, there is this well-known saying about the selling in May and going away. I was on leave for a couple of days in May, so it probably seems like I got it right. Mm-hmm. But I think the primary drivers in May was not inflation. It wasn't local factors as much as we would like to imagine that South Africa and the interest rates in Africa were driven primarily by local factors. It was mostly driven by a couple of very, very important offshore factors.
Mm-hmm. So get into those for us, because we're always talking about quantitative easing and the impact that the market's view on an easing back of the stimulus we've seen coming through from the Federal Reserve in the United States is having on bonds. But just kind of give us a background to that right now.
If you recall, in April we saw the Bank of Japan entering to what some might say also a quantitative easing process, or expansion of a quantitative easing process. This drove yields down massively. We saw the R1 at 6 go from just above 7 to deep into the 6%. And then in May, the reverse happened to a large extent. The US and the Fed began making noises that the quantitative easing process might be stopped, it might be slowed down. It is now just a matter of how much and when, rather than if it is going to happen. So right now the market is completely in flux, primarily because the entire idea of cheap and free and easy money and the support of the Fed might end or might be reduced, and the extent to which that will happen and the effect that which that will have on risk assets, of which South Africa is one, remains to be seen. So there's a massive state of flux currently, with markets locally and globally searching for direction.
Foreigners have really been helping our bond market, Cobie, for many months now, and it seems like that kind of has changed recently.
Yeah, I mean, if you look at the bond market globally, I mean, you're sitting off yields that are off 2-decade lows. So, if you just do a simple regression analysis and you take a capital gain into consideration as far as bonds are concerned, you can't take that as gospel, because that's probably going to start reversing and playing itself out from this point forward. You obviously have a lot of the inflation doomsdayers out at the moment, talking specifically about high inflation, the fact that this is bad for markets. But remember, in the global context, slowly building inflation that slowly builds over time certainly isn't a bad thing. Let's just quickly show you what that R186 actually looks like, and this is what Albert spoke about just now. There you can see the R186, and there you can see the pronounced kind of sell-off in bonds happening on the back end of what has happened globally. I mean, Albert, would you agree? I mean, 2 decades worth of kind of falling yields in the market. You probably would be kind of silly to buy long-dated bonds right now, or is that true?
Well, Cobie, I think that to a large extent, at the moment, right now, at this moment, I probably agree with you in the sense that I'm waiting to see what will happen in markets. So right now, I don't have any long-dated bonds in any of my portfolios. As a result of that, though, in a couple of weeks or a couple of months, the market might start seeing direction, and then we might start buying them again. There are massively opposing and massively contradictory views out there. You have Goldman Sachs calling for shorts on the US 10-year. You've got another couple of very large international fixed income hedge funds calling for the US 10-year going back to 1.7. So while I do agree with you that right now is probably not the time to take long-term duration bets, that time might come in the future. Mm-hmm. The US can't afford to let its yields on its long-term bonds run up too high, primarily due to 2 reasons. One is funding, and the second one is because a lot of their home loans are based off those long-term bond yields. Mm-hmm. And what is a beginning of a recovering housing market in the US will get a serious detriment if the long-term yields start to go up. So while the Fed might ease off on its quantitative easing, it's not going to stop it immediately, and it'll be interesting to see to what extent those effects will carry through into the local markets, because the local markets are very, very, very dependent on the US 10-year, for example.
How bullish or bearish are you on bonds right now, Roland?
Well, the interesting thing is that we're at the cusp of a long trend that seems to be reversing itself, but it's a bit early to really see that in the data. But we have seen very much that our markets domestically have been driven by foreign effects. Throughout 2012, we've seen the rand weaken, but our markets keep hitting new highs, both the equity and the bond market. And only now are we seeing the foreigners really in May selling the bonds. So again, this isn't an SA effect. They're not worried necessarily about our domestic economic situation, even though it's concerning. They're really looking at this global risk on risk off trade. They're looking at emerging markets. They're looking at this quantitative easing just vanishing at some point, unexpectedly so. But Albert, it sounds like you guys focus a lot more on Bernanke than Jill Marcus, and how closely do you watch these foreign portfolio flows, because those are looking rather concerning and might be the beginning of a new trend?
Roland, you're completely correct in the sense that the bond markets especially are significantly more concerned with Bernanke than it is with Marcus. While the money market funds will probably be more concerned with Marcus than with Bernanke to some extent, if I were to take a guess. But yes, the foreign portfolio flows are what has been driving our local market, both in the rand and the rand valuations, but also the bond and the bond valuations. We have been getting massive foreign flows. Not primarily because South Africa is such a good story, but because people, foreigners especially, were looking for yield all over the place. They were looking for Brazil, China, India, Russia, South Africa, and all our various competitors. And they were saying that if you have a decent economy and you have a decent debt to GDP ratio, and there's not too much going wrong at the moment, we are going to give you money. The problem with that is, if it's not country-specific factors that are driving those foreign inflows, then you are entirely at the mercy of those foreign factors that when they start reversing, it might have a very detrimental effect on those same positive forces that now all of a sudden aren't there.
And the reason it could start reversing is because people feel a lot more comfortable to keep their money in domestic markets like the US economy if we see better data.
Yeah, absolutely. And I mean, since the beginning of the year, you've seen that data change, fundamentally. The strange thing is, when the data was really bad last year, you had some fantastic buying opportunities, but nobody wanted to get in the market because they wanted to see these things changing. As a matter of fact, just to see quickly how data actually changes, if you look at your screen right now, there's a thing called an economic surprise index, and this is there's a couple of vendors for the economic surprise index. And in essence, what they're trying to gauge here is that how many times does the data actually surprise on the upside. That means when data gets forecasted, and every time the actual data comes out, is it surprising, is it better than expected, or is it worse than expected? And as this thing obviously drops, and as you can see it dropping all the way there, you see data obviously continuously surprising on the upside. And this is the big thing that's, for me, is kind of that's changing over here, is that you've got data that is surprising on the upside, in the sense that data is just getting better and better and better all the time. So more and more people are going to be saying, well, don't I want a growth story with my yield? And hence you're going to buy equities for yield, but then you're going to start seeing more and more kind of money flowing out of the fixed income markets. And you're not seeing that yet. You're seeing some of it, but you continue to see a whole bunch of investors saying, I'm looking for yield, and therefore emerging market yield is a better place to be than say, for instance, American yield or other places.
So in light of this, I mean, how do you manage a fixed income portfolio right now, Albert, in light of the flux that you say, in light of the uncertainty, in light of the question marks around whether this is the start of the great rotation that we've been talking about for many months?
If, let's say for argument's sake, that it does play out the way that Cobie has just lined up, economies in the US start doing better, inflation and growth there goes a bit higher, one of the things that's going to happen is our bond market will struggle and will probably continue to struggle going forward. As a result, you'll probably not want to be in bonds as much. That will mean you'll have to look for various other asset classes. Money markets, for example, are a very good example of this, primarily because they aren't negatively affected by interest rates going up at the back end of the bond curve. Their yields are primarily based on what's going to happen in the repo market. Also, if, for example, the economy does better overseas, we might see increased demand for our goods, and inflation and a couple other things that Africa might pick up. Our economy might start doing better, and Jill Marcus will be free to start raising front-end interest rates. This will help money market portfolios as well. So as a result, while you can have opportunities and participation in the bond market, a more longer-term strategy would probably be to underweight bonds and to overweight things that will be positively affected in these sets of circumstances. Things like property, for example, and things like short-term or medium-term money market instruments. Those probably will do better in the next couple of months or years if the scenario plays out as Cobie stated.
I mean, let's just maybe quickly look at one of the Atlantic funds. Just look at your screen. This is the Atlantic Enhanced Income Fund, and you could see what the actual returns look like. And this is obviously on the rolling basis. There you can see the blue shaded areas. The blue shaded areas obviously is the fund's relative return to its benchmark return. So you see obviously some decent outperformance, as you can see in that side of the curve. There has been some underperformance, obviously, especially when markets were very, very tough. And there you can see the benchmark of the fund. That'll all be 1 to 3 year total return kind of benchmark. Albert, tell us a little bit about this fund, the Enhanced Income Fund. How are you guys set this fund up at the moment in order to kind of take into consideration everything that's happening with yields globally?
Well, as I mentioned, Cobie, we are very, very underweight in bonds at the moment. We have approximately 5% holding in bonds, which is very, very low given that our benchmark is a bond benchmark. We have approximately 10% in property. We had about 15% at the end of April when we cut that down from 15 to about 10%. And then we have a lot of credit and cash and money market instruments as well as some preference shares. Now, those are some of the holdings we've looked at. There are, however, some interesting opportunities in these types of funds. For example, there are South African companies that issue debt offshore. One of the primary examples, or a couple of primary examples, would be Food Corp, Consol Glass, African Bank, for example. And sometimes those offshore credits provide very, very good yields as well, and we have participation in some of that.